Hi everybody, this is the LCG preview for the week ahead. I think we've all had enough of Brexit as of last week, so I'll try not to add too much on that, although some of it can't be helped. But the main things I'll discuss are the Federal Reserve interest rate decision and how that affects the dollar and US indices. We've got the Bank of England rate decision as well, obviously how that affects the pound, which is sitting around 9-month highs against the dollar at the moment, also the FTSE. And we've got the EU summit, which obviously does, I'm afraid, have some Brexit implications, and the S&P 500 making a new 2019 high as of last week. So as far as the economic calendar, it's pretty bare on Monday, but on Tuesday, we've got the RBA meeting minutes, UK unemployment, and German ZEW. On Wednesday, it's the Bank of Japan meeting minutes, UK CPI, and Fed meeting. And on Thursday, it's the EU summit, the SNB rate decision, that's the Swiss National Bank, obviously, UK retail sales, the Bank of England rate decision, and on Friday, we end things off with European services PMIs and Canadian CPI. And then as far as corporate earnings next week, the ones we'll be monitoring are Tilray, FedEx, BMW, Micron Technology, Next, Ted Baker, and Nike. So as far as those big things we're watching, we've got to put Fed at the top of the list. It's the week before last that we had the ECB surprise with a dovish tilt. We sort of knew they were going dovish because of the economic data, but we didn't expect the ECB to push a rate hike out into 2020 so explicitly. So that sent the euro dollar lower. We hit 112, but we've since rebounded to 113 after non-farm payrolls got completely obliterated and there was that weaker US inflation data as well. So in that backdrop, euro dollar back into the middle of its range. The Fed is probably going to be justified in its pause based on the recent data we've seen. Overall, US data is all right, but inflation and unemployment disappointed in the last month. So you would expect in the Powell presser, which is now going to take place every meeting, as we've mentioned before, that rates are on pause. That's pretty well understood. I think the only cause for turbulence here will be what Powell has to say about the balance sheet. How disappointed are the Fed? Are they disappointed enough to start put a pause to quantitative tightening? That would really put I think a rocket behind the US indices, Wall Street, the S&P 500, etc. But it's probably not too likely. Fed are more likely to be treading carefully for the time being, and if things deteriorate, that's when they take the action on the balance sheet. So on the flip side, talk of continuing without any particular update in terms of how they're currently operating in quantitative tightening, that could be a source of disappointment. So moving on to the Bank of England, another nothing to do meeting really, given all the Brexit turmoil. Obviously pound dollar, sterling is up at 9 months highs, around that 133 mark. Really the Bank of England's playing second fiddle to Brexit. We do have that EU summit on Thursday. So the big question there is, do the EU veto the delay to Brexit? It seems unlikely. It's in the EU's best interest to give the UK a bit more time, and who knows what happens in that time. The UK may even avoid Brexit altogether. So that's probably a risk worth taking from an EU standpoint, even though it prolongs the uncertainty. I'd be surprised. The only outside chance is perhaps one of the more populous members, Italy comes to mind, just veto the thing, even though the other 26 members are all in favour. That could derail it, and that would mean the UK leaves the EU on March 29th, as it was supposed to. But really, for the tone of the Bank of England, we can see what happens with UK CPI data earlier in the week. We're expecting 1.9%, so a slight uptick on the 1.8% year over year for February. So that would be a healthy backdrop in inflation, still slightly below the Bank of England's target. The point is, okay, A, Brexit, but B, after Brexit, what does the Bank of England do? The UK data really justifies more rate rises, but perhaps global data does not so much. So you probably don't really have the Bank of England backing for this rise in the British pound. So any more Brexit negative surprises of the pound, you don't really have the Bank of England underlying it, I think, based on the global situation at the moment. Worth mentioning the S&P 500, still struggling at that 2800 level, proving pretty sticky. Nonetheless, it did briefly make a new high for the year last week. So still equity markets fairly buoyant. Pretty similar thing with the 26,000 level in the Dow. Overall, you've got to say it's underpinned by this truce in the trade war. But if you think that the trade war is pretty much fully priced in at this point, that actually the US is going to reach a deal with China. So if you think the trade deal is priced in, then you've got to suggest that, well, okay, that justifies the rise. But if there are any negative shocks, for example, last week, Trump started to hint a little bit that he's in no rush to make a deal, then actually that's a negative potential shock for the market and why these levels could still potentially hold. Tech stocks, slightly different paradigm. The 7,200, we've broken out above there. Even though we've had all sorts of negative news from Facebook, the platforms were down last week. It looks like there's going to be a new investigation into how and why Facebook shared data with the other big tech firms. But investors just going with A, what's performed well over the last 10 years, and B, what was heavily sold off in December. It's a bit of a short covering rally still at this point. So whatever was being heavily shorted at the end of last year, which was tech, that's doing well this year. Right, thank you very much for watching. Go at trading this week. And if you want to see these videos as soon as they're released, please follow myself and LCG on YouTube and social media.